Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. So hope everyone had a happy Thanksgiving. And as we are going into the holiday season, we celebrate giving to each other, giving to charities, not only because it's Christmas, but it's also because it's year end and people usually catch up on their charitable giving to catch up on any deductions that they can take before year end to benefit from the deductibility of the taxes. All right, so now, as you know, the law has changed, and effective January 1st, 2026, a lot of things are changing in the charitable giving, related to the charitable giving. So how does that affect your 2025? And should you give more? Should you give less? How can you plan it? What can you do to optimize the change in tax law? This is what we're talking about today. So I'm gonna start sharing my screen and we can go from there. And as you know, I always like to start with a joke, and the joke is Christmas related. What is the, let me just put that, yeah, what is the employment status of Santa's helpers? Elf employed. All right, so what has changed from 2025 to 26 under the new tax law, and how can we use that for year-end tax planning strategy? The key legal changes that there is a 0.5% AGI floor for itemizers, those who use itemized deduction, effective January 1st, 2026. That's something that was never there before, and it's not there in 2025. There is a 1% corporate floor if you're making the donation from your C corporation. If you're not itemizing and you're taking the standard deduction, there is a new deduction available to you that's $1,000 for single, $2,000 for married filing jointly. If you made the donation to charity, you take that up to that amount as a deduction from your taxable income. There is a reduction of value for the high income donors because now the effective the benefit cap is 35%. It's not 60% anymore. It's 35% of your AGI, and whatever is in excess, you carry it forward for 5 years. So something that also changed from 2025 to 2026. So let's see numbers. For a middle income non-itemizer, your AGI, let's assume the AGI is 75K, you give a gift of a $1,200. In 2025, you get no deduction because you're not itemizing, so you get no deduction for your charitable gift. In 2026, you get above the line deduction, meaning you deduct it from your W-2, from your gross income, from whatever income you have. You take it up to $1,000 single, $2,000 merit filing jointly. All right. If you are a high earner, so this is another example. If your AGI is 750, you give a gift of a 50K. In 2026, there is a floor of a 0.5% of your AGI. So that's 3,750. Would consider as if you've never made it as a donation. You don't benefit from that donation as a deduction from your taxes. So in 2026, what gets deducted is 46,250, and instead of 50K, the full 50K, the full gift that you gave in 2025. Okay, if you're a corporate donor, yeah, the floor is 1% from your taxable income. So if your taxable income is 500K, you give a gift of $20,000, you lose $5,000. So only you get a deduction of $15,000 in charitable donation. Okay. What are the strategies that are available for 2025 since knowing these facts? First thing is to bunch multiple years. Like if you have some cash and you want to donate, instead of making a donation in January, make it in December. So if you're itemizing deduction, just bunch multiple years together in 2025. But if you're taking the standard deduction, then maybe wait till next year to benefit from above the line deduction, unless you're giving a donation of more than $1,000, $2,000 anyway, then it wouldn't really matter. Okay, so this is the basic strategy, the no-brainer strategies that we can use. Are there more? Is there anything else that we can do? very important and very effective strategy is to donate appreciated stock instead of cash. And why would we do that? To avoid capital gains. So instead of selling appreciated stock and donating the cash, it's better to donate the appreciated stock directly to the charity. So ask the charity if they do that and if they accept that. Let's talk about this in numbers. So let's say you had a stock that was the cost basis was 85K, the stock was 100K. So you have an unrealized gain of 15K. The capital gain tax rate, the long-term capital gain, let's assume it's a long-term. So long-term capital gain is about 20%, and you pay an investment income tax of about 3.8%. So you pay capital gain of about 23.8%. If you are the high, if the income tax rate is at the 37%, let's see how would that play the numbers. If you donated the 100, if you sold the stock, you would pay 23.8 on the 15K. So that means you pay 35.70 in taxes, capital gain tax. What about the donation? The donation, if you're donating the amount, the 100K net of taxes, then you donate the 96,430. So it goes to the charity less than what you wanted. So you get the deduction on the charitable deduction. So you get deduction at let's say it's your 37%. So you get deduction of 37% on the 96 instead of the 100. So now your net cost is the 100K minus the tax saving. It's about 64K net cost to you. Okay, so this is if you sold and then donated the cash. So let's talk about the second option, is to donate directly. In this case, there is no capital gain tax whatsoever. You don't pay it. The charitable gets 100K. The charity gets 100K. You get a deduction of 100K. At a 37%, that's a $37,000 tax saving. So the net cost for you is 100K minus 37, so 63 instead of 64 in the first option. So what does that mean? You saved about $1,300 in taxes, and the charity got even bigger amount. You got 35 more in donations that they benefited from. So especially if they decide to sell it and they're exempt from income tax, so it helps both of you. It's a win-win solution. So that's another strategy. What else can we do? Qualified charitable distribution for IRA owners. So if your age is 70 and a half or above and you have an IRA account, you know that you're subject to required minimum distribution. And what happens when you take distributions from IRA? It goes into your taxable income and you have to pay taxes on it, and usually it raises your it raises your bracket, so you have to pay on Social Security, and sometimes you have to pay higher premiums, depends on your income situation. So if you decide to donate directly from your IRA account to the charity, you have the option to do that up to 105K, and this number gets changed from a year to another. This number it's like it works perfect because it's not included in your AGI. So whatever number you're donating, it won't be included in your AGI. It's gonna lower your taxable income. It's gonna reduce your taxes of your Social Security, and you can avoid the higher Medicare Part B and D, and it works without itemizing. So whether you're itemizing or you're taking a standard deduction, it doesn't really matter because you're not including it in your taxable income. Because if you don't do that, then you would have to include in your taxable income. And if you're taking the standard deduction, then you absolutely are not benefiting from anything that you do as a donation. And if you're taking the itemized deduction, especially in 2026, knowing the changes, you may not benefit from it. So if you're giving if you're giving to charities anyway, and you have an IRA, then you better do it directly. Okay, so let's give an example. John, he's 73. Usually he gets RMD of 20K. He wants to make a donation of 5K. So the first scenario is to give just a personal check of 5K. In this case, he has to pay taxes on 20K. Let's say it's a 22% bracket. That's a 4,400 in taxes. But the second scenario, if he made the contribution directly, then he gets taxed on 15K, 20 minus 5. At 22%, that's the 3,300 savings. So it works perfectly, especially if you don't itemize, or especially next year even when you itemize, because it won't be subject to the floor. It won't be subject to the 0.5%. Okay. What else can we do? There are multiple strategies that we talked about in other videos, and feel free to get back to those or let me know, and I can give you more explanation, can tell you a little bit more about it. Use donor advisory funds. That's basically you're bunching in multiple years in one time. Like you put in a donor advisory fund, you take the deduction in the year when you make the donation, but then you can advise like for how many years, what charities can get what in those future years. But you take the deduction in full in the year you make the bulk amount into this fund. So that's a strategy. Another strategy is private foundations and charitable remainder trust when appropriate. And we talked about this in another video. Another one that I highly recommend also, especially in 2025, is the simple fee strategy. Like we also spoke about that when you donate appreciated stock or appreciated land or appreciated historical art, where they give you like a 5-to-1 deduction, meaning you give in $1, but you take a deduction of 5 times that amount that you donated. So you get back your $1, and on top of it, another half or another dollar, depends on your situation. So if you are having any question, if you want to know more about these strategies, if you want to run some numbers, some analysis to know what works for you and what not, please reach out and we'll be happy to walk you through it. All right. Thank you so much, and hope everyone enjoys this holiday season, and see you next week.